Right, good afternoon, everyone. Thank you for joining so punctually. We're going to kick off today's session with a short presentation from Mark Pattenden, who's our resident tax expert at Hayes-McIntyre. He's going to talk about the SEIS and EIS tax breaks. So straight over to you, Mark, and I'll rejoin in just under half an hour.
Thank you very much, Sarah, and good afternoon, everyone. We're getting used to doing these presentations online, but I must say I do still miss the days when we could all meet face to face and have a good conversation. But in the meantime, my name is Mark Pattenden. I'm a partner at Hayes-McIntyre. We're a firm of chartered accountants, and I'm going to talk to you today about the tax incentives of investing under the EIS scheme. Talk a little bit about my firm and then crack on straight away with EIS and SEIS, seed EIS being the junior version of the incentive scheme for much smaller startup businesses. I'll talk about the key differences between the two and then give you a few things to watch out for. If you've got any questions, please do put them in the chat and we'll try to leave time at the end of the session to answer them. So first of all, kicking off a little bit about Hayes-McIntyre. We're one of the top 25 firms of accountants across the country. We are a full service firm, so we audit large firms, we prepare the books and records for smaller firms, and we are tax advisors, both personal and corporate, to a huge number of clients across the country. We're also part of a large international network of accountants and lawyers called MSI, which enables us to introduce fellow advisors all around the globe to our clients who are internationally based. I'm part of our creative media and technology team, which is our largest corporate sector. As I said, we have a breadth of services all under one roof, from audit, accounting, tax, compliance, all sorts of corporate finance work as well. We are experts in high net worth individuals. That's where I spend most of my time, working in the personal tax department, advising entrepreneurs, individuals and their companies. So EIS and SEIS, basically this is a tax incentive scheme to encourage people to invest in startup and growth businesses. The incentive is that if you invest in a qualifying company, you will get income tax relief on your investment. The income tax relief depends on the type of company you're investing in, whether it's an EIS or a SEIS company, and we'll come on to the difference between the two very shortly. But for an EIS company, you will get a 30% tax relief on your investment, and for SEIS, it's 50%. But that basically means, you know, for a £10,000 investment, you could get £3,000 of income tax back. If you don't have enough income in the year that you make the investment, you can carry the relief back to the previous tax year, but you can't carry it forward. In addition to income tax reliefs, there are a number of CGT and capital tax reliefs. So capital gains tax deferral enables you to defer capital gains tax that you would normally be paying on other assets if you invest in EIS shares within a certain period. For SEIS, you can actually treat, rather than deferring it, which means that the gain comes back into charge later, like when the EIS shares are sold. For SEIS shares, you can actually treat half of the investment as totally exempt from CGT. So that's a real-time saving as opposed to a time deferral advantage with EIS. Disposal relief is the one that everybody's really keen on, I'm sure. And that basically says that if you hold your EIS shares for 3 years, and if you claimed income tax when you made the original investment, when you sell the shares, they will be exempt from capital gains tax. Now that's hugely advantageous if anyone invests in one of these unicorn companies that ultimately sells for huge multiples of your original investment. But even so, even if you just double your shares or triple the value, having those shares as exempt from capital gains tax is very useful. Loss relief. Not every company will be a unicorn. Not every company will succeed. Some will fail, unfortunately. It's advantageous to identify the one for those ones that are going to fail, to do so as quickly as possible, so you can get out and get as much money back as you can, or claim those loss reliefs when you can. Loss relief effectively converts the capital loss that you would have had on your asset into an income tax loss. So therefore you can claim it against your income rather than just having it as tax relief against future capital gains. This is much more valuable because being an income tax loss, it's tax relievable at your marginal rate, which could be up to 45%. One other item that is often overlooked with EIS is that once you've held the shares for 2 years, they're exempt from inheritance tax because they qualify for something called business property relief. And that basically means that small shareholdings in unlisted companies are exempt from inheritance tax. So if something happens, then your estate wouldn't be paying tax on the value of those shares. So I'm an accountant, so I'm going to put some numbers to all of this, as you might expect. These are two investments under EIS and SEIS, worth £10,000 each. As you can see, the income tax relief is 50% and 30% respectively, which means that you'll get £5,000 or £3,000 of capital gains tax. Of income tax relief. If the shares fail and you are a 45% taxpayer, then you will get an additional 2,250 of income tax relief, because the income tax relief is based on the amount that you invest less the original income tax relief that you claimed on the investment. So it's 45% of 5,000 or 45% of 7,000 under EIS. As you can see, that significantly de-risks the investment in that your risk of an SEIS investment is only 27.5% of the original capital, or 38.5% under EIS. If you were able to utilize the CGT element of your SEIS investment, you could claim up to an additional £1,400 of tax relief. Therefore, you could reduce your risk to just 13.5% of an SEIS company. So what are the conditions for EIS and SEIS? Well, they have to be qualifying shares that you're purchasing. You have to be a qualifying investor, and it has to be a qualifying company. All technical terms, so we'll go through them bit by bit. Qualifying shares, that means effectively ordinary share capital. There shouldn't be any redeemable element, there shouldn't be any preferential rights, and there shouldn't be any fixed exit opportunities, so no guaranteed payment at the end of 3 years, for example. The capital has to be at risk, and it has to be on a par with everybody else's risk. Skip to we'll come back to a qualifying investor, but a qualifying company. Effectively, a qualifying company is a trading company that has a UK permanent establishment. Now, there are some trades that do not qualify for EIS status. Generally, those are professional services companies, accountants, lawyers, and such like. And those in financial services, so banks, insurance, and property investment is also a prohibited trade. But any company that is producing goods, making things, that is providing software as a service, for example, will all qualify as an SEIS an EIS or SEIS eligible company. Now, so it has to have a UK permanent establishment. Now, that doesn't mean to say that it has to be registered in the UK with Companies House. It has to have some sort of branch or management or workshop here in the UK that establishes that it is performing its trade here. We have successfully qualified for EIS status for a number of overseas companies that are registered overseas, but have such a management or branch in the UK. The qualifying investor. As I said, they're subscribing for ordinary shares. It can be up to £1 million a year for EIS for the individual. 2 million if you're able to carry back 1 million to last year. Now, there is an extra £1 million for knowledge intensive companies. These are qualifying companies that invest a proportion of their income, their qualifying expenditure every year is in R&D, research and development. Individuals can put in up to £100,000 per year in SEIS. The investor cannot be connected with the company. That means that they can't be an employee, and nor can their partner or husband, wife be an employee. They must own less than 30% of the shares. And that includes those associated, those people you're associated with, so parents, brothers, and partners. You can be a director of an SEIS company and qualify for tax relief, but you can't be an EIS company director and qualify unless you became a director after the shares had been issued to you. So this is known as the business angel exemption, which allows people who have previously not been connected with the trade or the company, who are coming in investing, and after their investment are becoming a paid director or advisor to the company. Providing they're receiving a reasonable remuneration for their services, then that payment doesn't impact on their EIS status. Any follow-on investments within the 3 years of the initial qualifying event, the initial investment, will be fine, and they can also qualify for EIS. But any investments after the first 3 years will no longer qualify for EIS. Doesn't impact on your original qualifying status, but just prohibits you from being a qualifying investor after 3 years. So the key differences between the two: the investment limit for the individual investor, £100,000 or £1 million. The company's investment limit, £150,000 for SEIS, that's in total, not per annum, or £5 million per annum for EIS. It's quite often the case that an SEIS company will run a parallel investment policy, investment round, so offering both SEIS and EIS, and therefore it's up to them how they determine who gets what. It might become it might be on a first come first served basis. It might be on a on the basis of whoever pays the most gets the SEIS first. but that's down to them and down to you to negotiate between you. Qualifying company, an SEIS company has to be a new trade, which basically means it has to be less than 2 years old. Now that doesn't mean to say that the company itself has to be less than 2 years old. It means the trade. So if that trade has been carried on by an individual in their own capacity before they incorporated, that's something to look out for as part of due diligence, because if the trade is more than 2 years rather than the company, then it may not qualify for SEIS. It should probably still qualify for EIS, but SEIS won't be available. Gross assets of the company must be less than 200,000 and fewer than 25 employees for an SEIS investment. And of course, they can't have had previous EIS or VCT funding. So the SEIS has to be the first tranche of funding received. That's why if they do a funding of EIS and SEIS at the same time, they will close the SEIS perhaps the day before the EIS, because then you definitely know that the SEIS is the first tranche of funding. As I say, the connection, you are allowed to be a director of an SEIS company, but you can only become a director of an EIS company after the share issue. Money has to be used within 3 years. That most experience, that's usually 3 months or 3 weeks, given how quickly some of these companies will go through the money. And then effectively, in order to claim the relief, the companies have to have traded for 4 months, and then they can submit their application to HMRC for the investor certificates. So things to watch out for. As we said, ordinary share capital must be paid up in full and in cash on the date of issue. Can't have partly paid shares, you can't have IOUs, must be fully paid up. And it's the date that the shares are issued that is the relevant date for tax purposes. So if you are looking, things get a bit frantic at the end of a tax year, as you can imagine, as companies try to close around to make sure that things are completed before the end of the tax year. So, and the shares are actually issued before that year-end date, because it causes some problems if you hand over your money one side of the tax year and the shares aren't issued into the other, because that could impact on your ability to carry back investments and claim tax relief in prior years. As I said before, there must be no arrangements to protect the investments or arrangements for the disposal of shares, no guaranteed buyback, no special offers, no side deals, anything like that. This is fully at-risk money. Then there can be some complications in certain circumstances. Joint venture companies or subsidiaries. In a case of a group structure, you can only invest in the topco for SEIS and EIS purposes. You can't invest in a subsidiary company. So there's also some issues around share for share exchanges or group restructuring, that sort of thing. Things to look out for. Most entrepreneurs will be aware of these rules, and they will know that it's very important for shareholders to have this 3-year holding period before any buyout, any listing, any disposal event that could trigger loss of tax relief. Because if anything does happen within those 3 years, the income tax relief that you claimed at the beginning of the investment could be clawed back by HMRC. As I say, investment relief, EIS tax relief can be withdrawn if you sell the shares within 3 years, or if the company ceases to qualify in any way. Contrast that with a situation where the company fails just on the basis of it runs out of money or it just isn't successful. If you dispose of your shares because of a commercial failure, then those will not count for the loss of income tax relief. The key thing, the one thing that you must take away, is that you have to claim income tax relief on the original investment in order to get the CGT exemption on the disposal at the end. That's absolutely key. There have been court cases in the past where people have tried to claim CGT disposal exemptions on the disposal of the EIS shares, and where they have failed to claim tax relief on the past, then that's what the rule says, and they are unsuccessful. Shares are sold on a first in, first out basis, so you sell the oldest shares first. This may be relevant for business angels, where you have a mixed portfolio of shares that qualify and shares that don't. If you lose the income tax relief, then obviously you lose the CGT deferral and the CGT exemption as well. It says here, ask for a copy of the HMRC clearance letter. This is part of your due diligence process prior to investing in a company. One of the questions that you can ask is to see any conversations, correspondence that they have had with HMRC regarding their qualifying status. It is possible for companies on their first investment to make an application to HMRC to obtain clearance, that if they do everything that they promise that they will, and if HMRC will review the business plan, review their proposals and say, yes, this will be a qualifying company. It doesn't guarantee you get qualifying status as an investor, but it's quite persuasive, and it adds to your due diligence process of investigating the company. Very quick explanation of what a knowledge intensive company is. We mentioned them earlier, that you get an additional £1 million of investment relief. It's companies that are within, qualifying companies are within their first 7 years of trade. They haven't raised more than £12 million over the lifetime of the company, fewer than 500 employees, and they've spent at least 15% of their operating costs on innovation and research in the last few years. They must be creating intellectual property for the company, and that IP will then be exploited as part of the company's business over the next 10 years. It's quite a technical point, but it can be useful if you've got lots of income and lots of tax relief that you want to claim. The latest developments, often companies now need to demonstrate that they have active investor interest before HMRC will grant them pre-clearance. This can slow the process down, so investors might be asked to sign a letter of intent or something like that, so that the company can proceed to making a qualifying status. Funds have to be used to promote the growth and development of the company. Again, technical term, but it just means that they can't use the money raised under EIS for paying dividends. It has to be for recruiting new staff and just growing and expanding the existing business. Certainly can't use the money to pay off debts within the business. I think that's everything that I've was going to discuss. Sorry for the very whistle-stop tour. Normally this is about an hour-long presentation. Sarah, do we have any questions?
We do. We have an excellent question from Simon Thorpe, who has he's asking about claiming losses, and in brackets he says yes, all experienced investors have those. How do you see diminution of value claims on tax returns, and in your experience, are they generally accepted by HMRC?
So diminution of value. I'm assuming this is negligible value claims. So companies
Yeah.
that haven't actually gone bust, but are significantly reduced in their value. I think with a negligible value claim, HMRC will generally expect that the company is on its knees and probably doesn't have a prospect of coming back. They regard negligible value as being next to nothing. So they wouldn't regard a company that you invested in, for example, you invested £100,000 and it's now only worth £1,000. They wouldn't regard £1,000 as being negligible value. What they would be expecting is you can make a negligible value claim retrospectively for a company that went into receivership or liquidation in the first part of a tax year and make a negligible value claim to say that it was worthless at the end of the previous tax year. So you're really looking at companies that are on their very last legs or have gone subsequently bust, and you're making a claim retrospectively.
And it can be quite a long period of time before the company reaches that stage, because there's there's administration, which is quite lengthy, isn't there? So, at what point can you make that claim in the life cycle of the company, if that makes sense?
No, you're absolutely right. And the worst companies are the zombies that just carry on doing very little, but nobody actually puts them into administration or liquidation. And unless there is virtually no prospect of any recovery and no prospect of getting any refund from HMRC, HMRC will push back on a negligible value claim.
So is administration a point at which we can make a note, because they're still trying to sell the assets, aren't they?
Yeah, administration isn't liquid. It is not, obviously is not the same as liquidation. So administration does have a prospect of something coming out. It might not be what you want. It's the asset is still technically owned by the shareholders until the end of that process, until we find out what happens with the company. Liquidation effectively is all the assets and everything belongs to the liquidator, and therefore you've effectively disposed of your shares. It's not quite the same with administration.
No, so it's quite a long period of time tends to elapse before you can actually get your
yeah.
loss.
I mean, as I said earlier, the best thing is if it's going to fail, make it fail fast, rather than dragging on.
Okay, well, thank you very much, Mark. As usual, that was an excellent summary.